Dave, how are you doing?
I'm doing great, Ryan. How about yourself?
Doing good. Round 2 of the podcast, and I'm excited to have you on the show for various reasons. The last time you were on, there was no world pandemic, and things were pretty straightforward, and so it seemed. And I was just telling you that I've witnessed a couple presentations that you and Prairie has done over the last 4 to 6 weeks that have been fantastic. And with your guys' heavy involvement in the ESOP community, doing annual valuations, and then us working on some clients together, I said, you know what? Let's get you back on the show and talk about valuations and what the heck is getting priced into them, and can we even price them? So maybe for the listeners that have not listened to that previous episode, Dave, just give a quick short background on your background, Prairie, what you guys do at Prairie, and then we can jump right into it.
Sure. So Prairie Capital Advisors is a company that's an investment banking firm focused on helping privately held business owners execute on ownership transition strategies. So from merger and acquisition advisory and representing people who are selling to third parties, whether they be strategic or financial buyers, to family transfers of stock within a family, management buyouts, as well as ESOPs. So our goal is to advise privately held business owners on their alternatives, and then ultimately to help them to execute those strategies to gain a liquidity event.
And it's what I think is super interesting about Prairie, and you and I have talked about this, and I think my listeners have heard it. But I mean, you guys are a partial ESOP yourself. I think you got some 50-some employees. You do what is it, 300 valuations on ESOPs every year, Dave? And
yeah, so about a little bit over 300 a year on the valuation side.
And then you also sell to third parties, strategics, management, and or private equities. You guys have exposure all over the place. And I think, even in today's world, you can have some sort of insight if you do a couple of transactions a year for an investment banker, but like you guys are exposed all over the place, from ESOPs doing current valuations. And so I just find it very interesting with your guys' model and how you guys do it. And then how it's education focused first. And so I give that insight because that's going to be relevant in today's topic on like how things are getting valued and how this is impacting different, exit options, the sentiment that's out there. And so, when you think about like maybe just kind of give an overall, or may give you some insight on the practice, Dave, of the 300 valuations, because I think that's crazy important on understanding how ESOPs got to be valued and how they were getting valued at the end of last year and then this year. And then we can kind of talk about why that's changed and what the pandemic has done to it.
Sure, absolutely. So, for every ESOP that's done, and this is the case where we're working on the buy side, so we'd be representing the trustee who's looking to purchase the securities. The company needs to be valued on an annual basis. And you're right. I mean, this gives us some pretty unique insight into a whole host of companies and what's going on in different industries and different geographies currently. And most of those companies have 12/31 year ends. So for those companies, we're going through activities right now where we're valuing those entities, and we've either just completed them or we're in the process of completing those valuations as of December year end. Now, for those valuations, there was really no pandemic. There was no idea that anything was going to have this level of impact. So those valuations were done with the mindset at the time, which was economy was good, everything was looking strong, and we're moving forward. The problem for some of these entities is because certain parties leave the ESOP company and they need to be bought out. There's been a lot of companies that have had some pretty significant impairment in their performance subsequent to that. And there's some companies that have, mid-year pricing or mid-year end that we need to value now. So if you're 3/31 year end or a 6/30 year end, very different dynamics that are going to be entering into those valuations. But for those that are even just doing administration that were, calendar year end, they're looking at things, and if their business has been significantly impaired, we're doing a review of those entities to see exactly how much value is dropped and to work with them on consulting on ways to best handle this significant decline in the market values and general activity. So, we're seeing a whole lot, of different things. I mean, some companies are performing rather well, but there's a whole host of companies that have seen reductions in force or furloughs and a significant drop in their business activity or supply chain disruption and whatnot. So, there's certainly a different mindset now I will say too, though, that one of the greatest difficulties right now is really picking a date. Because Ryan, as you're seeing in the stock market right now, the volatility in pricing has been pretty significant, and even just choosing one date versus a date a week from then, depending on the situation, if you're just valuing a company or depending on when their year end is, can have a pretty significant impact on how you're viewing the market. So we're looking at a little bit longer swath of pricing when trying to come to a conclusion at that exact point in time. Drawing on a little bit more of the history, 30-day history on where the stock market has been, so that we don't get pulled into multiples that are predicated on on a short-term pricing of like 1 day or 1 week.
Yeah, some sort of reality. And
Absolutely.
so before we go down into the economy, what has like how you're pricing different scenarios and valuations, what I think we should do, Dave, for the listeners, let's set a couple building blocks of foundation for valuations, and then we can get into how industries will impact the different things that are impacting those valuations and the recalibration. So like maybe we can start it off with just when you're valuing a company, because you guys do ESOP valuations and valuations on an ongoing basis, and for a lot of different reasons, the financial valuation, and then there's what we like to call the strategic valuation. So there's kind of two different ways to value a company. So maybe want to set some ground rules and framework before we dive into what is being impacted on that.
Sure. Certainly from a financial buyer perspective, and this encompasses most of the private equity community if they're looking at a company for a platform investment or for an ESOP, who they aren't bringing any real synergies to the table. You'll see some pretty consistent pricing of these entities. There will be variations from an industry standpoint and certainly from a growth standpoint, but largely those companies are pricing transactions and valuations based on a combination of obviously the external environment and also what they can borrow in order to make the purchase. So, the financing markets play a key role in looking at this and coming to that conclusion. And they're looking at what the cash flow generating capability of that company is, and then what kind of leverage they can use to purchase that or to value that entity. Now, strategics, on the other hand, oftentimes can actually have a lot of synergies that they're able to bring to the table, and it may be that they have some overlap in distribution, with space or with anything that relates to marketing, or even just their ability to produce that product with existing machinery, whatnot. There's a whole host of things that they can do to generate additional cash flow in that entity, and so those entities often can, if they really want the deal, can price things a little bit more in a little bit more robust fashion, because they're actually receiving greater cash flow at the end of the day.
Well, and I think you hit on a couple of good points here, Dave, because when we talk about financial valuations, you talk about the ability to borrow, and then another way of putting that is it's based on the health of the cash flow and the sustainability going forward, right? Like it's based on the discounted cash flow and what is our confidence that this machine, which is a business, can produce cash, and then therefore you could just have some sort of debt service that you would place on that based on the health of the cash.
Absolutely, and the environment that you're in really can dictate some of the pricing. So if banks are in a position where they're willing to lend and willing to lend larger volumes of capital, that keeps your cost of capital down and gives you the ability to put in more money into a deal. So when banks are lending, say the latest quarter for Q1 in 2020, we were seeing in most of the financial buyer deals that senior debt to EBITDA was at about 3.5. Now, we've had times, and we may well be seeing a time here soon, when that reduces down to 2.5 times EBITDA. Well, if you're getting a turn less of leverage, so one turn of EBITDA less of leverage, it really limits your ability to pay up. And so the freer the capital is on the banking side, the more robust the pricing is for people when they're selling their securities.
So, and I think we can here's what I'm just kind of obviously flying on this is maybe we can dive into like the things that are impacting those financial valuations, Dave, because I think the lending and the financial markets have to do with it, like you were talking about pricing based on the stock market, and then also industry risk, company risk, all that stuff. Let's unpack that first, because then the strategics, they use that as a baseline, but then there's other reasons that they're going to layer on top for that transaction to generate their cash flow. So maybe let's unpack the financial, the market. So when you're saying that, like, so why would a bank not want to lend that extra turn in EBITDA? And then what are other major concerns that people are looking at? Is they're looking at the ability for this company or a company to borrow?
Well, for some cases, it's a question of, where's the risk, and what does the bank's own portfolio look like? Obviously, we saw in the last recession, in 2007 2009, banks really started to put themselves in a position where they were looking to improve the quality of their credits, and so they wanted to lend less money into deals. They wanted to take more secure positions. They had enough headaches on their hands, and therefore they pulled back some of their own risk tolerance from a banking standpoint, that they didn't. They wanted to create a greater secure portfolio within their own bank. So we're seeing
like getting out of commercial real estate, or like, I mean, all the different things that they might have had exposure to that they shouldn't have, right, will impact the overall portfolio of a bank. Just same thing as any normal investor.
Absolutely, but it ebbs and tides, and the banks themselves, they find themselves in that cycle where it's a question of, okay, well, things are good, there's opportunities out there, but everyone's chasing those opportunities, and therefore they need to get more aggressive in order to get the deal and to be able to book the loan. Then there are times like now when things have gotten a little bit dicier, and they're dealing with some of their own portfolio issues within their own companies and their own loans that they have, and they're going to become a little bit more constrictive, and they're not going to be as lending at quite the same multiples that they had even a few months ago. And we're already seeing that start to happen. In this environment, it's kind of interesting too, because some of this is happening just because they're not able to utilize their internal resources, their people, as much as they would normally, and that's partly because the PPP, so
Yeah.
the Paycheck Protection Program, has really caused an incredible inflow of new loans to these banks, and so a lot of the bankers have been pulled off of that. But it's also a result of a lot of the headaches that they're seeing again in their portfolio, which is causing them to be a little bit more conservative in how they're looking at new opportunities, particularly considering that most of the companies themselves, don't have a whole lot of visibility into what their own performance is going to be. So it's hard for them to convey, and difficult for a bank to go risk on right now at a time when the markets are in turmoil.
Well, I think what's a crazy thing that we need to separate here is, like, so you do valuations annually for 300 plus ESOPs, which in order to eventually do an ESOP, your financial maturity and clarity has to be pretty rock solid. I mean, like, you're doing trailing 12 months, you got forecasts, you got budgets, you got all those different things. And then you have the general private market, which is, who knows, right? I'm sure you and I both have stories. I literally have a bank that told me, Dave, about 6 months ago, he goes, yeah, our 2020 goal is to clean up our customers, and we want to have clients where their balance sheet balances. But that was his statement. So, like, how do they even know, like, what's happening inside of their company, the companies that they're lending to, other than that they hopefully they have enough assets to when shit goes south?
Absolutely. No, this is a case when definitely they're changing their risk profile, and they're changing their risk profile because of really what's going on in the external markets and the lack of clarity. And so this is certainly a case where the banks, and this is not unusual. I mean, again, when things are good and they need to chase deals, again, they're getting overly aggressive, and they're trying to win work because they need that in order to grow the company, to grow the bank. But when things start to head south, they almost collectively start to rein their belt back in and start to reduce exposure, and that's what leads us to these sorts of environments generally.
So then let's, because they're thinking about that. I think this is a good bridge into risk, and how are we pricing in risk to valuations? Because I think the biggest challenge that lots of people are talking about right now is what's going on in the M&A marketplace. How is this whole new world getting valued. I think what was the mug that was going around in a picture, which is EBITDA, which is earnings before interest, taxes, depreciation, and COVID. So
Yeah.
like, is this an add back? What is how are people pricing in the new risk? Is it by industry? Is it by size? Is it depending on who's pricing it? Like, how is this whole situation being taken into account?
Well, we're learning as we go along here, quite honestly. M&A activity is down about, depending on who you ask, about 80 to 95% in April and May. So as all this has been going on, we're seeing a lot of deals pulled from the market. We're seeing deals that were in process becoming canceled. We have two deals right now that are continuing to move forward, and one of them actually is performing well, and the pricing hasn't changed, which has been a bit surprising, but it's set to close in the next month. We have another deal that we're looking at that has two companies that are merging effectively, but both companies have similar risk profiles as it relates to dealing with the pandemic. And so because they're doing a share exchange, they've stuck with the pricing that was there previously as well. So, if you're performing well in this market, I think you can, if you were already in process, there's a good chance that you can see that deal through. But a lot of deals, particularly if there's any hiccups at all, are having difficulty in getting closed.
Well, go ahead.
I was going to say too that there's some other elements there related to rep and warranty insurance. So rep and warranty insurance is being a little bit tougher to come by right now, and that's become a huge part of almost all these deals to help to reduce their escrows. And they're putting greater restrictions on that insurance, not to mention some of the pricing. So some of these deals that we've seen that have come off the market, most of them have been performance related, but the ones that have still been moving forward, the rep and warranty insurance is being diligenced much more deeply than it is normally, and it's with greater restrictions.
Well, it's so crazy to me, Dave. Like, so, and I'm super curious to hear your answer to this. Is like when I think about like the clients that your team and our team has worked together on, and we're looking at a financial valuation. So you take the discounted cash flow and like the biggest determining factor is a company specific risk. Like how risky is that cash flow? And then you say, okay, well, we take all the add backs out and we normalize the EBITDA, and let's say it's $1 million, in normalized EBITDA. Well, great. Like in ideally in the discounted cash flow, you've got the forecast, right? You're looking at 3 to 5 years out. And like, we don't even know how consumers are going to spend for the next 2 years, when the vaccine's going to come out, what hospitality is going to look like, what bars are like. We don't know how that's going to happen. And like, I think about the people that have the supply chains that supply to those. How do you even project out? Because like, like they say, okay, well, the COVID's going to be an add back. And I'm like, well, that's if we just waved the magic wand and all this shit disappeared. But like, when you don't have, out of one group of friends, who's going to go out, who's not going to go out because there's so much uncertainty. How do you price that in to a valuation?
Well, that's the tough part. And you're right. That comes down to some of the company specific risk and some of the general market risk that we're seeing right now. So, yeah, I think you're going to see most people certainly make some adjustments as it relates to COVID. There'll be a good amount of add backs, and rightfully so, particularly on the PPP and some other just general impacts as far as the supply chain disruption and whatnot. When you're buying equity, you're buying the future. And so what we're needing to do is take a look at what the future prospects of the business are, as you mentioned, with the DCF and and any other forward-looking metric. But there's a whole lot of uncertainty, and that's really what we're seeing right now, which makes it very difficult, which does, like in a discounted cash flow analysis, which does cause you to increase the company specific risk. If you're in a pure deal environment, whether it be an ESOP or a straight M&A deal, I think if you're trying to get a deal done right now, one, it's a buyer's market. So the buyers certainly are the ones that have the advantage currently. And you're seeing those buyers come out and say, okay, well, if you really need to get out, we'll show you where our pricing is because we're pricing in this risk. And even with that, they're likely to tell you that there's going to be an earnout component in order to get to reasonable pricing on multiples. And so, they want to share in that risk. And they certainly don't want to inherit it day one when they're putting cash to work, immediately. So, they're going to need to see and have some protection as they move into these deals. So it's either price reduction or earnouts or clawbacks, some form of protection.
And which makes sense why there's certain strategic acquisitions that are potentially still happening, right? I mean, because like the acquirer knows their industry and they've already factored in their own industry risk, right? Like they've got probably experience and they understand like how things might happen, and so they have an idea how they're going to generate the cash flow from the acquisition, right? I mean, they probably still have the cards compared to the seller, but like how do you? I'm just trying to think of like, what are the other things that are seeing the ripple effect other than the consumer spend and how things are going to, reopen? You and I on a previous phone call, we talked about how this has exposed supply chain issues. And then, maybe talk about how, when you're pricing a company, why the stock market, you mentioned the stock market and why that matters, why supply chain and what's happening. Cause I think there's the general understanding of, okay, I understand the shutdowns and how the pandemic has happened there, but like the other things that might be on a layer or two deeper that people might not think about.
No, I think, certainly, like you said, there's a lot of COVID related things that are there that are in your face. We still don't know exactly how that's going to play out. But then on top of it, you have partners that you're working with in your supply chain, whether that be domestic partners that may not have the financial wherewithal to withstand, what's happening to their business in the current environment, or international trade partners in your supply chain that, given the, trade dispute and war with China. I mean, there's a lot of people rethinking their supply chain and the risk that supply chain brings. So a lot of this is coming closer. I mean, we're seeing a lot of companies who are in that supply chain, carrying a lot of inventory because the orders were put out there by their end customer, and they're just not taking it. And so, the supply chain continued to move, and they stopped accepting orders or stopped accepting product. And now the companies are trying to figure out how to deal with that and deal with the working capital aspects of that. So there's a lot of different elements that you need to look at as you're valuing firms. And we've seen some firms come through this pretty cleanly, but others that have had outbreaks of COVID that needed to shut down for a period of time, others that are starting to experience a little more financial difficulty and liquidity issues that have disrupted things. And it's tough because you can't see where the end demand is coming on one end, and then even as the demand's there's often some hiccups and difficulty in securing the products that you need in order to work. So it's a very difficult environment, and so the diligence aspect of this is something that is tough to come by, and that so it's tough to go through because you're looking a little bit more deeply into all
Everything.
aspects of your business more than you were in an environment like that. And one of the biggest issues in any deal related activity right now is due diligence, because if you can't get on site to meet with the people, see the operations, do all the normal monitoring activities and investigative activities that you do in a due diligence process, deals aren't going to move forward. And that's really been for any deal that was just getting started, that's really the reason that a lot of these have hit the brakes, outside of just the lack of clarity on the demand side of the equation.
So, like, yeah, there's a couple different ways I want to go with this. Like going back to like the supply chain, and I mean, because we've got clients that are manufacturers, and they're not exposed to the customer, like you said, and all of a sudden they had a surge in orders, and then dropped off in April, right, or May. And so like there's like different ways that it's the supply chain's getting impacted. Like, what are your thoughts, Dave, when you look at like, I just go back just to the pure consumer. And like, I mean, I haven't touched my wallet for like months. It just sits on my counter. I mean, given the fact that I do have an app that that is tied to Amazon and everything else, it still gets stuff delivered to my door. But like, just the amount of savings that I've had, or like just the average consumer from not going out, is like, so I'm watching this and from my own maybe perspective, I look, okay, the PPP covered some pain for 8 weeks, and there's a whole bunch of administrative pain that comes with that. But is that shedding us from some potential some cracks that might happen when like the real lack of consumer spending is going to catch up to us in 60 to 90 days when we realize that it hasn't picked up like it should have?
Yeah, I think there's certainly something. I mean, we're keeping an eye on that, and obviously a lot of our clients are. But there's a real issue here. I mean, we were looking at historically high unemployment, and the unemployment numbers don't actually reflect what they would be had we not had the PPP, because a lot of our clients, including ourselves, we have a PPP loan. You know, in order to keep, given that the government shut things down, this money was there to allow you to retain all of your
Hmm.
employees, and those a lot of those people would have been laid off or furloughed otherwise. So the question is, when that runs out, and if the demand doesn't pick up, are we going to see people in the opposite position? I mean, you're mentioning now, okay, well, saving money because I'm not going out and haven't touched the wallet. I think there's a lot of people that are doing that. But then the question is, okay, once we get through, if people are continuing to save money and don't get that money spent, there's going to be a lot of people that continue to be on unemployment, which then, leads to reductions in demand and reductions in value then of those companies and whatnot. And the external stock market is, been interesting because the way that it's acting, I mean, Wall Street is without question disconnected from Main Street in what we're seeing pretty broadly. And when the S&P has 20% of its valuation tied to the five largest tech companies, those companies are thriving, and there's a reason why those are driving up. But the S&P really is disconnected in large part from the rest of general valuations. I mean, I think there's likely a compression in multiples that's going to happen because there's going to be less growth. But there's also the case where the actual multiplier, the earnings piece, is going to be dropping as well. So I think there's without question going to be some impairment on that end from a valuation standpoint. And we're hoping that obviously this picks up and that people go back to spending as usual. But the psychology of where people are is making that hard to believe in the near term. There's just such a wide spread of
It's crazy,
how
Dave.
people
I
are
mean,
viewing
like,
things.
yeah, and like I want to make sure that I touch on a couple of the points that you made because so I'll start with that when we talk about consumer spending. I've been the Economist has been a great resource that I've been diving into over the last 3 months as this is all gone over. They got the 90% economy edition. One is that God, they're talking about consumer spending, all these different things, and like I think about it, and you're going back to the PPP. The I have had clients that said, "Yeah, I literally am going to fire 50% of my staff in 7 weeks when my PPP is gone." like, and it stems from their visibility into there's no way that my business or industry is going to be as normal. You know what I mean? Like, because like they're a supplier of material to a trade show or to an event or a concert or something like that, where like even like those things aren't coming back for a while, right? I mean, like I can't imagine spending 40 grand on a booth. You and I both had been trade show sponsors, right? Are you spending, is Prairie spending 20, 30, $40,000 at a trade show anytime soon? And like all the, gear material and all the suppliers that have, material goods and services that they supply to those. I mean, that's just tough. And like how that, when you start to really see that in the economy, I don't know. I mean, if it's going to be in a couple months and how does that make sense? I mean,
No, absolutely. And I think it's, yeah, with that and even the conferences, I mean, how much, the people that are going out and spending $100
booze,
a plate
food,
dinners, and,
yeah,
and, flying on
hotels.
planes, staying in hotel rooms, doing all those things. I think it's definitely something that's going to take a while to get back to normal. Not to mention colleges and the ecosystem that surrounds college campuses and the needs of those kids and how much money flows through the system based on that. There's a whole lot of things that certainly are going to be impacted, and it's not going to, the switch isn't going to turn on overnight. And again, a lot of that comes back to the psychology aspect of it, because it would be very difficult right now for me to say that if we had are normally 20 people going out to a certain conference, that all those people would be comfortable doing so. It's going to take a while for some of them to get back to where that seems to be logical.
Well,
And
and
the
even you
question
as a
is,
business owner, right, Dave, you would have to, wouldn't even before you made that decision, wouldn't you want to know as an investor in that situation, is the 1,000 people going to be in the audience? If it's only going to be 180, I'm not spending 40 grand for that. You know what I mean? Like you just kind of think about, it's all about exposure to people, right? And the wallets.
absolutely. I mean, it's a ripple effect for sure, and it goes through a whole host of different areas that it's tough to see that it's getting back to where it was, because definitely money was flowing pretty freely and the economy was going well and people were spending on growth. But right now, when the focus is on protecting their entities and protecting their people, it's a much different mindset with regards to how money is going to be spent, and certainly on anything that's travel or conference related. I mean, most of the conferences that obviously we're seeing now, even out a few months, are all being converted to virtual conferences.
Mhm. So going back to the stock market and then investors, and so the stock market being decoupled and disconnected from true reality. One thing that hasn't really impacted, or well, so you got the Fed that's been stimulating the economy, doing bailouts left and right, and you have one thing that the big stat is the private equity firms that have this 1.5 trillion dollars, whatever the number eventually is, in their coffers, right? So you had the big investors, pension funds, endowments, private equity, that are pricing, the funds are flowing to the stock market because they're racing for safety and storeholder wealth. And then you've got private equity firms that their investment thesis is to buy companies, privately held companies. What is their attitudes towards this? Because they still have the money, right? They still need to get the rate of return for the other investors that put the money in. What's the chatter been going on amongst those crowds?
There's, like you said, there's about 1.5 trillion, and then about 500 billion in deals that were done last year. So they got 3 years worth of deals relative to last year's volume that they have available.
Jeez.
The difficulty for them right now is again, lack of clarity, lack of ability to conduct diligence, like I was talking about before. But also, they need the credit markets in order to really pursue deals, in any meaningful manner. So right now, it's definitely advantage strategic as far as acquisitions are concerned. Although most strategics need to access that as well, but they can oftentimes again get synergies, and many of them have balance sheets that allow them to to borrow capital across a broader swath of assets than private equity firms do. So I think private equity certainly needs to get some of this capital deployed. And what we're hearing is that they're looking out to the future and feeling really good about what deal flow is going to be there, but they'll pursue deals that are put on their plate right now, but it's likely not to be at the valuations that we'd seen previously. They're gonna want to have some greater confidence in the trajectory of the company's performance, and if they don't see that, and if it's not abundantly clear and the company doesn't have the right story to tell, it's likely that they're going to see reduced pricing or earnout type scenarios come into play. But there's a lot that needs to be done in order for them to get to get all that money to work.
No
And this
kidding.
environment is really making it difficult. It's really shut things down pretty heavily.
Well, and they were struggling before trying to win deals at reasonable prices, right? I mean, you were hearing 14 times EBITDA, and which they still need to get the return. So it's a completely opposite end of the spectrum problem, right? Where now now they got problems of trying to get deals done, getting the financing. But when you say that they feel good about the future, is it because they think that there's going to be pain, that they're going to be able to get the returns that they need for the investors, or what's driving their good attitude, or their
I think they believe there's some pent up demand as far as people needing to exit businesses, whether it be their own portfolio companies, or more importantly, that there's a whole host of baby boomers that have yet to to sell. So there is certainly some good demographics to feeding that and fueling that industry. But I think in general, I think the fact that they were all, like you mentioned, they were fighting to levels of multiple elevation that was diminishing their return, that they're looking at scenarios now that will likely bring that down to where they can actually step into something and achieve a reasonable return if they're willing to create liquidity for someone today. But time will tell. But I think there was an expectation prior to COVID that there was going to be a very robust M&A market this year, and that private equity was going to play a huge role in that. Yes, they've had to pull back the last few months to really take care of their portfolio companies, and that's taken some of their eye off of the growth side of it. But now they're not seeing a whole lot of things come across their desk. The amount of pitch activities, as I mentioned, was down significantly, and part of it is because it's hard to present a company, to private equity or anyone else if you have a lack of certainty in the company's ability to perform. And we can recast all we want, but if the story's not sound and if the data isn't playing to the story, you're going to see very limited demand. So I think once this settles, people are going to get a chance to see who was able to deal with this well, who wasn't, and you're going to have some people similar to the last recession that found themselves in a position that they weren't anticipating being in, and maybe the business owner is in a risk off position and wants to sell the company, even if it means taking a haircut to what they would have received just a few months ago.
So I'm curious, with your experience, Dave, you've been through multiple recessions. And on one of our previous calls, you were talking about how the 0809 recession is different than now. And what are some common themes, or maybe not common themes? What are some things that you saw in 0809, how things shook out, how evaluations, how they unraveled, but then not unraveled, but how they played out. But then also, what did the successful people do? Because right now everybody thinks this is never going to go away, but the reality is it will, right? And there's people acting right now and lining strategies up, whether you're private equity or you're a seller. And what are things that you saw work well and not well in 08, and how does that translate to now? And then how is it different?
Well, I think for anyone who is getting ready to sell their business, I think part of it's just making their business look better, understanding what the market is going to be looking for and what makes them attractive. And if there are some improvements to be made, whether they be personnel or just operational modification, that they start to make some of those. It's kind of just preparing for when the environment shifts to where it becomes attractive again, and having yourself look more attractive for that. It's the equivalent of losing 10 pounds prior to going out in the dating world. It's so,
Yeah.
I think, it's a matter of just finding the best way to present the company. We also saw, and I'm expecting that we're going to see here too, when the financing markets start to dry up and there's limited amounts of capital out there to access, at least on the ESOP side of the equation, we saw more people doing deals with, seller financing, and in some cases even 100% seller financing, going through getting the transaction completed, already having that in motion, expecting that 12 months from now, 18 months from now, that when the debt markets open up again, that they're able to go to their bank and refinance out some of those seller financing. So for those that were ready mentally, that really is a good option if they're looking in the ESOP route, just to hold the seller paper and to wait for the liquidity event for a little bit, but know that you're working through already the process and you're running the business in a 100% ESOP scenario as a tax exempt entity, and you improve your cash flows.
That's super interesting. Yeah, that makes sense, because that's a really interesting strategy. Also, other strategies I'm curious is when you think about the real world example that just got hammered through everybody's perspective of what truly does sustainable, predictable, and transferable cash flow look like, right? Because that's true value in cash flow. So I think we've all now got a better understanding of what that means, and that's just not as easy as most people think it is, because the 12-year bull market that we had. What are things that you're seeing, or are there things that you would recommend to current business owners to say, okay, look at your supply chain. What are the stories? What are the things that they should be doing now to lose those 10 pounds? Is there things that you see? And then that kind of goes back to the 0809 comment. Is there things that you would recommend kind of put, the building blocks that people should be focusing on?
Well, certainly, supply chain was some of it. And we saw a lot of people, shrink the number of parties in their supply chain and look for higher quality coming out of that recession. We also saw a lot of automation come into play, and so certainly putting in some automation, looking at maybe how fat their workforce was. If there's positions that maybe someone's retiring, does that position really needed, or are we able to structurally just change our organization a bit so that others just absorb that? So I think we definitely came out of that recession with companies that were leaner and more effective at producing sustainable cash flow. So there was a huge improvement at that point in time. I'd say that I'm expecting that we're going to see a little bit more of the same here. And there may be some cases now as well where if people see that their workforce can work remotely and there's a way to reduce some of their exposure from a cost standpoint to some of their physical space, that may likely happen. I mean, there's certainly some negatives to doing that, and but in a lot of instances, I think people have seen that hey, work from home has worked well for them. It's worked well for their employees, and either there's a full work from home situation or at least some modifications that can allow them to reduce some of their real estate costs.
Yeah,
But,
I think when you said it, like, when you think about the recalibration and doing the good hard work, right? I mean, do you think? I mean, I just look at this, Dave, and I'm like, the companies that do the hard work, right? Like, have clean financials, have a good strategic plan, like, they're going to get rewarded for that hard work, right? Versus like I think about the incremental value of doing that like a year ago. I mean, I think about just even selling what we sell, and like you had mentioned that you guys thrived after 0809 because people wanted help. I mean, like, the people that do the hard work are going to get rewarded for it because there's a lot of people that have been caught off guard and kind of sleepy.
oh, absolutely, and it takes a lot of effort to change things, and so there's some people that just they're not willing to invest the capital to put the business in a position to to grow and to present itself well. Some people take a view that okay, well, I'm just gonna keep producing the profit that I am, and I'm not going to reinvest much into the business, and I'm not going to do all the hard work to do the planning and to make the internal modifications. And most of those people just see their businesses continue to dwindle rather than maintain. It's the ones that actually go out and do the planning. That particularly if they're looking at an exit, then do the planning. Make the improvements, show the incremental change that can happen based off these, and show that it's repeatable. And you really find yourself in a position where you can be rewarded in the long run. It costs money today, but certainly makes you money from an investment perspective later, and allows you to maintain your competitive advantage.
I want to pull that thread for a second, Dave, because we Pat and I talk a lot about shifting your mindset away from annual income to long-term value creation, which you just described, right? And I think I don't know what your experiences with all the deals that you've looked at is. I find it that a lot of entrepreneurs have that struggle because they don't know how they're gonna harvest that value, right? They don't necessarily know how to actually look at that rate of return because it's too much like of a fictitious number, right? Like, I can make 500 grand this year through distribution salary versus like, reinvesting and then making that worth 2 million in 2 years. What comments would you have for the listeners who are struggling with that? And then like, how to tie what they're doing in right now towards a longer goal like that?
It's a tough thing. I mean, it's you're looking at someone oftentimes if they're getting ready to exit, or if they're even 5 years from exiting, they're thinking if I deploy this capital, that I just throw it down the drain and find myself in a position where I've just reduced my net worth. You're right. I mean, if people don't do that, what they need to realize is that there's a competitive environment out there, and that people are constantly changing and modifying, and there's new business risks that continue to pop up that again can cause some erosion in their value. It's important for the company to look and show that it is thoughtful, that it has strong management, that it's willing to make investment, and ideally, obviously, you see the results of that investment to really get top multiple that you can for the business, and to get a wide audience that's there to create an auction environment when you're looking to sell. So making an investment and continuing to make investments is key. And we have that issue when that's one of the first things we tell people when we start to represent them, whether it be for an ESOP or M&A or any type of buyout, is that you may feel like you're getting close to the finish line, but if you take your eye off the ball, you can see, and we've seen it time and time again, people all of a sudden think, okay, well, I'm in the mode of selling, and they see their performance start to dip when they're in the middle of a time when they're going to be becoming priced. for their ultimate exit, and they see a lot of value erosion. So it's key to continue to keep the throttle down, for everyone, because again, the external competitive landscape isn't going to take their foot off the gas, and so it's important to keep moving forward.
So that kind of gives it's a good bridge into like the strategy that we preach a lot, and I'm curious on your feedback on this, Dave, because like when I think about like true freedom and options for an entrepreneur, it's like you build a healthy business that kicks off cash, but that means you're constantly reinvesting in the right strategies that produce value, they increase your EBITDA or your multiple or paying down debt. Somehow it's march in that direction. And when I think about like what you guys do when you have ESOPs, management, the structures, as well as private equity or strategic, I mean, those are the four major options for exits. You know, because an ESOP is a financial valuation, you can kind of predict and control what that will eventually be, depending of whether there's a pandemic or not. But given like the most amount of knowledge and that you can have, you can kind of plan that out. So what I've said to others is like, hey, if you can continue to reinvest in keeping that healthy business, you can eventually have the options of a strategic or private equity sale that is the right buyer. And if that doesn't work out, you can always fall back and pretty much guarantee that you can do an ESOP if you've built a healthy business. But you can't shortchange all the investments to hopefully hand off your company to the perfect strategic buyer without any plan. I mean, it's kind of like playing all options at once. I mean, any thoughts on like that kind of strategy?
No, I think it's a perfect strategy. I think everyone, for the entrepreneur who goes and builds a business, you want as many alternatives as you can. I mean, because there's aspects of a deal that are purely financially related, and there's other aspects of a deal that relate to more emotional issues, and where you want the business to be, and how you want it to move forward. If you're someone who again isn't investing in the business, you create something that doesn't have sustainable cash flows, you really limit your options and your pricing. And this goes for a lot of people, and one of the biggest mistakes we often see is that there's someone who's an entrepreneur who plays things way too close to the vest, and they don't bring up management that is able to run the business autonomously. Certainly they may have an important role in that organization, but they need to groom that next level of management in order to create a sustainable situation. A lot of people have the assumption that if they go and sell to a strategic or financial buyer, they're going to bring in a SWAT team of experts to run the business, and that's just most often not the case. They don't want to do that. They're buying a management team.
Yeah,
And
cash
so
flow.
if the entrepreneur wants to leave, that'll cause a huge reduction in price and a lot of difficulty in selling that business to any party.
And I think about right now, like the stuff that's probably going through people's heads and the conversations I have is like, depending on where the entrepreneur is in the life cycle of their life and the business and all that, is like, you know what, this sucks. And I'm not doing this again, especially if they're in their 60s and they'll live through 2 or 3 recessions. Like, you gotta at some point get exhausted. Just like, clipping coupons and getting the distributions forever is just maybe not as viable as they thought at the end of 2019. And I think about hopefully the bad decisions that don't get made is like, I just want to get rid of this, right? And how much value is lost when they have that depleted passion and energy compared to, hey, I want to, for 36 or 48 months, build a very specific financial strategic plan that does these things. And like, you can pre-engineer an ESOP, right? I mean, if you do it right, you can do that and know that you've got control over that. And then if you ultimately want to sell to a third party, you can do that as well, but you're going to get the value that you know that you have spent so long building. Any thoughts as you have conversations and have gone through many recessions of, help giving some encouragement to the entrepreneurs that just got the crap kicked out of them?
No, I mean, I think it's exactly that. I mean, you got to keep your eye on the ball, and it's hard. I mean, if you were getting ready to retire, it's difficult because this is definitely likely elongated it, or it's going to cost you some good money that you've spent, again, decades probably building. So again, having that plan and having an idea of again improving the business, improving operations, getting your management team in line and productive, and being a management team that actually can succeed you and and move forward with the business in your absence, is key. And this is key if you sell the business, but even if, say, you enter into that situation, and we have the situation play out that we're in right now, and all of a sudden there's a recession and you are burnt out, you've got the people in place to continue running the business with just you maybe acting in a board capacity or something. I mean, it gives you the options to either hold or sell. And, it's a real key point. And again, one where we see, people stub their toe a pretty decent amount, and that they don't put themselves in a position to perpetuate the business with their own personnel.
Well, and do you see right now as a huge opportunity, Dave, to like go acquire the talent that wasn't available like only 2 months ago?
I think you have the ability probably to acquire some of the talent. I also think it's these times that allow you to recognize the talent, because sometimes if business is just going on as normal, you become a little bit blind to maybe how good certain people are. And, we always see that in recessions, you'll see some people step up in ways that you never imagined that they were capable of. And maybe it's just because it wasn't their job, but now all of a
Mhm.
sudden they're realizing, hey, we're in a different position, and this needs to happen, and we need to see success, or my own job or career is at risk. And you'll see those people pop up and become a little bit more apparent that they're someone who can move into a role that maybe you discounted their capability before. So, but there is going to be some external talent as well. There's definitely going to be people and good managers that have been displaced. So, whether it's internal or external,
That's a really good
definitely
point.
some opportunities to recognize and to elevate.
So, like, as we're wrapping up here, and I want to loop it back to valuations and like, I'm just thinking of in those stories that we just told about people in different perspective or different timelines and energy levels, and they go, okay, now here we are. Like, now is the time to understand. Like, I mean, like realistically, what are we looking at for like when a normal, semi-normal like valuation will be obtainable? And then, like how does that, where are we in that timeline? But then also, can you maybe, lend some insight on, even though the valuations might be somewhat, to a normal state at the end of the year or whatever you say it is, then how does that impact on the deal structures? Because just because the valuations there doesn't mean the deal structures are as pretty as they were a year ago.
No, agreed. I think in the here and now, I think you're going to get hit with reduced valuations and more restrictive deal structures based on where we're moving and what we're seeing in general. And again, this is crystal ball stuff, because there's just such limited visibility. But I think it'd be surprising if by late third quarter or fourth quarter we don't start seeing a pretty significant pickup in activity for me. But a lot of that's going to be predicated on the banking environment and the business development corporations that lend into those deals. So, I mean, the BDCs right now are really restrictive, and that's a lot of what has been funding private equity deals. So, those guys and the banks, they need to get themselves comfortable. They need to get the PPP behind them. They need to get themselves in growth mode again, where they're lending into these situations. And ideally, the dust will have settled on at least the shutdown aspect of how the pandemic has played out, and we'll get to run rates of 3, 4,
Whatever they're going to
5
be. Yeah.
months that prove out the investment thesis to tie into what projections are going to be provided. So we're
Yeah.
hoping that it's going to be at the end of this year. Now, it likely for the near term is going to have some additional restrictions on structure, but you know again, we'll see. The hardest part for us right now is that as you're asking early on, what's going on in the market, how are deals being structured, how are deals being priced. The reality is they aren't.
Because they're not happening.
They're
Right.
not happening. And so, there's a lot of speculation about what's going to move forward. And yeah, if there's a strategic that sees a company and the company has some strategic importance for them, and there's some synergy there, and it's a buy versus build, or it's just something that they've coveted for a while, they're likely going to find a way to make that happen. But if it's a company that's being taken to market if it's performing really well, they'll have some people that'll look at it, because those companies are hard to come by right now. And so again, you have private equity with dollars to spend. You will see probably some pretty nice activity and interest
Hmm.
in those companies. But there's a whole host of companies that had a bit of a ripple in their financial performance, and I think it's going to take a good 6 months for that to shake out to where we get back to some sense of normal.
Well, and I think, Dave, what an amazing time, honestly. If you take the silver lining of it, is like for an entrepreneur that's listening, going, okay, well, whatever they're going through, they're like, like an amazing time to buckle down, build your financial foundation and a strategic plan, and actually put some intention behind it. Say, okay, here's what I want, because either A, you're going to be able to acquire your company or competitors that are not doing that stuff, because there's a lot of people that probably aren't. And why? I mean, if you're planning on selling in the next 12 to 18 months, why not do this? And you probably get a higher multiple, because there's not going to be as many people doing the same thing as you, and there's no reason to do it right now. And or you could, like, if even if you had no intention of selling, you're still going to have an opportunity to take advantage of the opportunities of the competitors or the people in your landscape that didn't do this stuff. I mean, I don't know. I just, even though it's a lull, I think that there's an opportunity to be awake when people aren't.
Absolutely. Well, I think people have spent the last 2 months, if I mean, unless they weren't necessarily impacted, which isn't a whole lot. They've been in triage mode, and as you come out of that, you're right. I mean, it all comes down to planning. I mean, this will change, and the situation will change. The economic environment will change, and it's all about changing your positioning. In the 2007 through 9 recession, you know, we basically made sure that we kept all of our employees. We wanted to make sure that we had everything intact. Most of our competitors weren't, and we planned and prepared for what was going to happen when we came out of that situation. And we had a huge spike in our own growth during that period, and it all came down to planning and a commitment to growing for the future, knowing that there was going to be demand. We just wanted to be positioned to be one of the parties that was able to serve as advisor for that demand. And so
Yeah,
it is
it's
critical. I mean, planning is a huge key, and it's tough to do when there's difficult times. But as you mentioned, that's when there's the real opportunity.
well, it's so funny. I was talking to one of my friends who owns a big business here in town, and like, the reality is, I mean, people will go back to doing the normal things, even if it takes 24 months. Like, that would be excruciating, but like, the reality is there will. I mean, people like to eat, drink, hang out with friends, period. Right? And they like entertainment. So it will go back to that at some point. It just matters of how long and how healthy the balance sheets are of the companies that can wait that long, and or do the right things between now and then, because it's just a marathon at that point, and who can last.
No, absolutely. We'll get there. I mean, we're hoping, right? And like I said, right now there's limited visibility, but it is starting to clear up a little bit. I mean, the green shoots term is started to pop up with some of the PE guys and the people in our industry. So it's good to hear that they're starting to see at least some change in the direction that we're moving, and that's what we need. And we're starting to see, again, companies get a little bit better handle on what this is all going to mean to them going forward, and that's critical. I mean, having some confidence and some visibility is key to getting us all to move forward, and for entrepreneurs to have a market that they'd ever want to sell into.
So I want to hear what your main takeaways are, and then before I do that, I'll put a link to the PDF that you guys have. You guys have a great one on the COVID-19 pandemic and deal structure, or the M&A world, and you got a bunch of resources that we'll link to Prairie and everything like that in the show notes. If you're what take any major things that you'd leave the listeners with, in as far as it relates to like how to handle the rest of the 2020.
If I had a perfect answer, I wouldn't be sitting here, quite
You and I'd
honestly.
be rich sitting on an island.
Yeah. No, I think it's a matter of that. It's a matter of taking care of of the liquidity situation of the company. If there's one area that we're seeing issues, it's about liquidity. So keeping an eye on that and understanding the dynamic. Building out multi-week forecasts of cash flow, having as good a handle on that as possible, and planning for the future. It all comes down to that. It's, the bottom line is making sure that you're financially healthy enough to move forward, but then, not being afraid to look at the future and look at how to address the future and take advantage of opportunities.
One last question for you, and then I want to know how the listeners can get in touch with you. Is what does the word intentional mean for you?
Intentional is a well thought out and purposeful plan, effectively, to move forward.
What's the best way to get in touch with you and the team at Prairie?
You certainly can access our website at www.prairiecap.com, or certainly email me at diehl at prairiecap.com. I'd be happy to answer any questions.
Dave, I appreciate you coming back on the show. I had a blast.
All right. Thank you very much, Ryan.